Today I'll be presenting my investment analysis and valuation of Netflix. I'll go through the company's business model, industry outlook, competitive positioning, financial performance, valuation, risks, and end with my investment recommendation. Netflix is a global subscription-based streaming platform operating in more than 190 countries. The company operates a single business segment focused on original and licensed video content, including TV series, films, documentaries, and mobile games. Revenue is generated primarily through paid memberships. Netflix invests heavily in original content, which helps differentiate the platform, strengthen its brand, and reduce reliance on third-party licensors. As the market leader in global streaming, Netflix benefits from strong scale and data-driven content production. The global video streaming industry was valued at approximately 250 billion US dollars in 2025 and is expected to grow at over 10% annually. Growth is driven by digitalization, on-demand consumption, rising internet penetration, and widespread use of smart devices. There's also a structural shift away from traditional broadcast television towards subscription-based streaming services. North America remains the largest market, while the Asia Pacific is expected to be the fastest growing region. Technological advances such as AI and data analytics further enhance content personalization and user engagement. Netflix has a wide economic moat supported by several key factors. First, its strong global brand and first mover advantage in subscription streaming drive customer loyalty. Second, Netflix's data-driven content platform uses pro- propri- proprietary analytics to guide content investment and improve user engagement. Third, economies of scale allow Netflix to spread high fixed content costs across a large subscriber base, boosting margins. The combination of brand strength, data, and scale makes Netflix's competitive position difficult to replicate. Looking at Porter's five forces, the threat of substitutes is insignificant due to Netflix's unique original content, convenience, and largely ad-free experience. The threat of new entrants is low because entering the global streaming market requires high capital investment and scale. Supplier power is also insignificant, as Netflix's in-house original content reduces reliance on external studios. Competitive rivalry is significant, with rivals competing on content quality, pricing, and platform features. Customer bargaining power remains low due to Netflix's extensive content library and personalized experience. In summary, Netflix is a pure-play global streaming company with a strong competitive moat. The company is improving monetization through pricing power, advertising, and account sharing controls. Based on my analysis, Netflix offers approximately 40 to 45% upside from the current price. Therefore, my recommendation is buy with a target price of $120. Netflix's growth is supported by multiple drivers. Subscriber growth is boosted by paid sharing initiatives and the ad-supported tier. ARPU continues to expand through pricing power and tiered subscription plans. International expansion, especially in Asia Pacific and EMEA, remains a major growth opportunity. Advertising monetization provides a new revenue stream, while data-driven content investment improves efficiency and cost discipline. Financially, Netflix shows strong and improving performance. Revenue has grown consistently over time. Operating margins have increased from around 20.6% to 29.5% and are projected to reach approximately 32%. ROE and ROA have improved significantly, reflecting stronger profitability. At the same time, free cash flow generation continues to grow. My valuation uses a multiples-based approach, with a DCF used as a cross check. I apply a target multiple of 18 times 2026 estimated EBITDA. This premium is justified by Netflix's scale, expanding margins, and strong free cash flow generation. I also compare Netflix to traditional media companies and other streaming peers. There are several key risks to consider. First, Netflix spends tens of billions annually on original and licensed content, which can pressure cash flow and margins. Second, competition from Disney Plus, Amazon, and HBO may limit subscriber growth, especially in mature markets. Third, adoption of the ad supported tier and higher pricing remains uncertain, and weaker than expected demand could slow financial growth. From an ESG perspective, Netflix is actively developing its framework. Environmentally, the company focuses on emission reduction and clean energy use. Socially, Netflix emphasizes global workforce diversity and inclusive content. From a governance standpoint, Netflix has an independent board and strong oversight. Overall, ESG initiatives support long-term sustainability and brand trust. AI creates both opportunities and risks for Netflix. On the opportunity side, AI improves content recommendations, increasing engagement and retention. It also helps analyze scripts, predict hit potential, and optimize production schedules, reducing costs. AI further supports targeted marketing and better monetization. However, risks include content biases, copyright issues related to AI generated content, and potential regulatory restrictions on AI usage. To conclude, Netflix benefits from strong growth, margin expansion, and improving cash flow. It remains the market leader with a wide competitive moat. Key catalysts include the ad-supported tier, pricing power, and international expansion. I therefore recommend buy with the target price of $120, offering an attractive risk-reward profile. Thank you for listening.